details, and I hope you hear your details. I hope that you guys have it helps you to answer any questions you may have. I kind of like those kind of instructions. I'm a checklist person, so I like to have everything organized. And so let me know if you have any questions, but the gist of all those details is there's an ethics statement online as an assignment. So print it out, sign it, send it back as an assignment. I am not allowed for you to have you sit at the exam unless you sign the ethics statement. So it kind of makes sense. So please do that. Please do not start sending ethics statements to me via email. It's too much. I mean, like, it's too much to manage. That's why we have an assignment. And then I need to do the cross-reference between, between like DS, who sent it to me via email, who sent it to me as an assignment. Please don't do that. Just, you have a due date, there's plenty of time. Please just make sure that is done on a timely fashion. And then other than that, just connect on, at 7 p.m. on Tuesday, or if you have been approved for an alternative time because of the time zone where you are at the alternative time, and you connect to the Zoom link of our class. I share with you the password, and then you start the exam. The exam is 60 minutes. And again, you can go back and forth with the questions. But we're going to pause for a moment so IT can troubleshoot the issue that we have, and then we'll talk about a little bit the content. Yes, go ahead. Sorry.
No, no problem.
Yeah, there's no choice of the echo.
Yeah, no, this was just not on, I think.
It wasn't on?
Yeah, like I don't know who turned off
The USBs?
yeah, so like this part, it should be on, so like it's powered. So it should be good to go now.
Okay, thank you.
So,
How do so I just need to make sure that,
yeah, this
it
was-
never,
Nobody, I don't know
nobody
why
ever
it
does
turned
it,
off.
yeah. Yeah.
But it should be working now. Can everyone hear?
Can everybody hear me better? Okay, good, excellent,
Awesome.
thank you. Thank you so much.
No problem.
Thank you.
Anything else, just give us a call.
Thanks. Well, I know we have technical issues, but the beauty of all this is that we are located across the street from the IT. So that's awesome. If we have a technical issue, they can come right away. So content of the exam. The exam, and thank you so much for running and going to grab them. So content of the exam is, the exam will be from chapter 1 through chapter 5. Like I said, I typically do not share the number of questions just because it creates either unnecessary anxiety or unnecessary enthusiasm. And the exam has been, taken from, from a series of individuals, and to make sure that it was fair for you guys to take. And so we are pretty confident as far as how fair the exam can be. It covers, should you expect questions on preparing financial statements? Yes. Yeah, that's all what we did. And so that's, I would certainly think about reviewing the material. We spent a lot of time, covering certain topics, especially presentation of financial statements, the allowances and all that. So it kind of, the accruals. So it is expected that you guys will find that into an exam. We have tried to stay away to the best of our ability from questions that have multiple parts. However, there are going to be questions that have more than one part just because of the nature of the question. So hopefully they are not overwhelmingly, like multiple parts, but that was our intent. But we've tried to stay away from the ones that are here are all the journal entries and here is the financial statements. Beautiful problems to give to people at this stage, but probably with a different format, especially considering everything we're going through. Yeah, any questions? No? Okay. So yeah, I mean, as a reminder, I won't see you on Monday. I will see you directly on Tuesday. One more thing though is because I had a family emergency yesterday, you guys should have gotten an email from me about office hours. And so I have office hours today from 4 to 5, and then Monday, just because we have an exam, I have additional office hours. So I have from 1 to 3. So, hopefully there's plenty of opportunity to touch base. All right. So having said all that, and again, feel free to email me with questions. But I'm gonna switch gears and we're gonna start talking about inventory, and which is not going to be part of the exam, obviously, just because we're just going to be introducing it today. And yeah, I mean, it's an interesting chapter just because I think, just because it is, it's one that people can relate to because we buy merchandise always, well, it's part of our life in a way. So there's a component of that that is neat just because of that. All right, so inventory. Like I said, any questions, any thoughts before we have you guys done other exams already? Yeah? No? Well, some said yes, some said through Zoom? Or like, yeah, how were they? Was it good? Was it a good experience? Okay, so people seem happy. Now, Samantha, what happened?
For statistics, it was a
I'm
hard.
sorry, we can't hear you.
Oh, you can't hear me?
Hold on 1 second. I don't know if we have resolved completely the issue. Here you go. Samantha, try now, please.
Can you hear me?
Yes.
Oh, it was just for statistics. It didn't go well.
Well, I mean, like you did it to yourself, statistics. Yeah. It's a big one.
Yeah.
Said you did it to yourself. I mean, we all have to take it at some point in life, but how do you guys? I mean, I know this is not ideal, but how do you guys feel like with being on Zoom and during the exam? Does it make any difference from being in the classroom? No. All right. I'm curious because every time we do something different, I'm curious to hear a feedback from the students and see if there's anything that we can improve upon. But good luck with your results of the statistic exam. Have you gotten the results yet, or like you're still waiting?
Oh no, I got them back. It was okay, but it was a hard exam for me. So
yeah. But you have to give yourself credit. Statistic is a tough one. So, all right. So inventory and cost of goods sold. So just again, like the first thing that we try to do is think about like big pictures of how. There you go, much better. Think about big pictures of how. Where do we classify, where do we where does like inventory and cost of goods sold where is it in our financials? So we talked about about sales and uncollectible uncollectible account expenses. And if we look at the balance sheet, assets on the right and liabilities on the left, liabilities obviously and stockholders equity on the left, then Sales and uncollectible accounts expenses are associated with accounts receivable and allowance for doubtful account. Sales trigger accounts receivable, uncollectible allowance for uncollectible accounts triggers uncollectible account expenses. So then inventory triggers cost of goods sold, meaning unless I have an inventory, I can't sell it. And cost of goods sold represents the amount, how much it costed me to purchase the merchandise that I was selling. So if we look at it at a roadmap, which I love to give my students, you know, like there's a little typo over here. I apologize. This should read as chapter 6, not chapter 5. But inventory and cost of goods sold are related. Here's where they sit in terms of the financial statements. Like inventory sits among the current assets, and cost of goods sold is the element of the income statement that is instrumental for me to get to the gross profit. So sales revenue minus cost of goods sold will give me my gross profit. So, you know, one very satisfactory, satisfying thing for me is when we get close to the end of the semester and we see that pretty much we went through all the different elements of the financial statement. That's, you feel like accomplished, at least I do. So in the balance sheet, again, inventory, it's not necessarily booked as a net value. We have, you know, it's listed typically under receivable. And for example, for Walmart, the inventory for 2020 was 44 those amounts are in millions, so it was $44 billion. And that gives you a sense of how important inventory is in retail business, which is what we're going to be focusing on. Because we don't have the instruments, we don't have the tools of focusing on inventory for manufacturing. That's going to be what you guys are going to do for AC 222. You're going to spend lots of quality time with Professor Sabin of Professor Asadorian to talk about, you know, how you go from raw materials to finished goods. Why inventory is so important? Well, it basically, like, look at how big it is for a retail business, you know, and if you look at Walmart over here, the consolidated financial statements, you have net sales of 519 billion, cost of goods sold of 394. So it's one of the largest expenses in the company income statement, if not the largest. Again, really depends about the industry, but it is one of the largest. And so there's a lot of scrutiny that goes into it because inventory is subject to valuation. Because we're going to talk about cost flow methods that are evaluation methods. And so inventory is one of those items where if you are interested in pursuing a career as an accountant, you might take at some point an auditing class. Inventory is one of those items that auditors look at with a lot of scrutiny, just because, quote unquote, just because, depending on how you evaluate the inventory, you may swing the profit from profit to loss or vice versa. So, and also inventory can be obsolete and you keep it at instead at what you purchase it for, which it creates an overstatement of the asset. So you are really misleading your investors and whoever reads your financials. So inventory, as we said, are goods held by a company for the purpose of sales to customers. Inventory is like, it's not goods that are held for consumption of the firm. Those are called supplies. I have a supply room. Typically, big companies have supply rooms that are like ginormous. And those are goods that are consumed by the company, but they're not inventory. They are supplies. They are assets, but not inventory. They are part of the current assets because they are resources. Remember, we talked about assets as our resources. And so the expectation of the company is to be able to sell these resources, and so that these resources will give us a future benefit. As I consume my inventory, as I sell my inventory moves from asset to being an expense called cost of goods sold. I am typically not picky when it comes to the way you call certain expenses. Honestly, if you call it rental expense as opposed to rent expense, or insurance as opposed to insurance expense, I'm not very picky, even though, I mean, the good thing about my lab is that it sort of drives you in the direction of what would be a good way to call an account. But you must know you must call cost of goods sold, because there's a fundamental sort of need to use the terminology correctly in this case. So when inventory is purchased or produced, because again, retailers will purchase for resale, or merchandise like companies that have finished goods, but there are also companies that produce inventory. So when a company, whenever the inventory is ready to be sold, is recorded as while in production, is recorded as an asset and is carried in the balance sheet until it's sold. When it's sold, the inventory is the cost of the inventory is removed from inventory and transferred to cost of goods sold in the income statement. This is, I mean, I know we talked about this several times, but this is a very, very important element here that we need to understand. Otherwise, we're not going to be able to understand the cost evaluation, the cost flow methods, using the proper words, which we're going to be doing next class. So gross profit equals sales revenue minus cost of goods sold. And unless you book properly the cost of goods sold, not only you might be overstating your assets, or understating your assets, or said differently, misstating your assets, but you also might be misstating your income statement. And as we know, revenue and income are the elements of the financial statement that investments look at the most. And so we need to make sure that they're properly represented. That's why there's so much emphasis in making sure that transactions associated with inventory are properly recorded. So yeah, I mean, remember how crucial the cost of goods sold is for the determination of the gross profit. So another thing that we need to keep in mind here, guys, is the concept of sale versus the concept of cost of inventory. Because one thing that I noticed in the past teaching this class is that students try to use this interchangeably. Meaning, like when I tell you merchandise was sold at $50, the question should be how much it costed. Instead, students what tend to do is get that $50 and consider that cost of goods sold. That's the sale price. If I go to CVS today and I go buy my toothpaste, I'm gonna pay, I don't know, because I actually, buy bulks of those, so I don't even know how much one tube of toothpaste would cost. Like, let's say $5. So I go there and I pay $5. That's not my cost of goods sold. That's how much I paid. That's my sale price. The cost of goods sold, the cost of the inventory for that toothpaste, it might have been $1 or less. So sale price is the price at which the inventory is sold. Do not confuse the inventory, the price the inventory is sold, with the cost of goods sold. It's the sale, it's the revenue. Is the revenue piece. Whereas the cost of the inventory is so your cost of goods sold is the cost at which the inventory was purchased. That's what you put on the cost of goods sold. So if I go to CVS and I buy my toothpaste, I'm gonna pay $5 that will be the revenue for CDS. Their cost of goods sold, I'm gonna assume, is $1. Their gross profit is $4. So the cost of goods sold expense is based on the cost of the inventory, is based on how much is the cost that I incurred to purchase the inventory. All right, so cost of merchandise acquired is also another very important topic. The cost of merchandise acquired is not just the, so again, we talked about sales price, we talked about cost of goods sold. Cost of merchandise acquired is really not just the amount, you know, how, say I'm CVS now and I'm buying the toothpaste from my supplier, from Crest. And so the cost of that merchandise of that $1 is not just the unit price, the unit cost of the toothpaste, but it might include transportation charges offset by discount, offset by return and allowances. So that $1 is a net value. It might be that Crest would charge me $1.05 for, I'm sorry, it might charge me, let's just say 95 cents for the toothpaste, and then 10 cents for the transportation. But then I got 5 cents discount. So the cost is $1. The transportation charges can be free charges that are like typically, you know, it's free on board destination when the seller bears the cost, free on board shipping point when the buyer bears the cost, and free in or inward transportation, which is part of an additional cost of the goods acquired. It's not sort of like itemized. So the FOB means free on board, and we're going to look at like a next slide. I'm going to give you a sense of why this is important. But in essence, I am going to book for the transportation of that toothpaste. And of course, I broke it down by individual item, but only if I pay for it. If Crest tells me it's free charge of delivery, then there's no transportation that you need to add to the cost of the merchandise. So if Crest doesn't give you a discount, then you don't have to offset the amount by a discount. So it really depends on specific circumstances. So, and the transportation charges may dictate whether or not you're going to end up adding the value of the transportation, the cost of the transportation to your merchandise. So let's look at it. Free on board means it's what we sort of consider, we call it FOB or FOB. So FOB shipping point, it's where the buyer is responsible for freight costs. So CVS is responsible in that case for the cost of transportation. At where? At the shipping point. Whenever they go get the merchandise from the Crest warehouses, then they will pay for transportation. Well, CVS is paying for the transportation cost for the toothpaste. Then they are entitled to book it as part of merchandise inventory, as part of the cost of the inventory, because the cost of the inventory is not just the cost of the actual toothpaste, but is also the cost associated, like the landing cost, like the cost associated with bringing that merchandise to my premises and make sure that I can sell it. Offset by, again, if Crest gives me a discount or an allowance, offset by that. Then there's the FOB destination, where the seller is responsible for freight costs. So CVS says, don't worry, I take care of the freight cost. Then the CVS, I'm sorry, not CVS, Crest says, don't worry, I can take care of the freight cost. But then at that point, CVS has no argument to book the transportation in because they didn't really have any cost of that transportation. From an accounting standpoint, what happens is that Crest will book that transportation as an expense of the period. Whereas if CVS has incurred that cost, as in the case of shipping point, CVS will book that as part of the merchandise inventory because it's a cost instrumental for getting my resources that will be beneficial for me in the future. So I can capitalize that cost. Whereas for Crest is a cost instrumental to make a sale, and it doesn't have any benefit in the future. It's like a sort of it's a discrete cost for that specific sale. So hence I expense it, right? Crest will expense it right away. Does it make sense? All my little spiel about transportation costs, which is fascinating. I mean, if you look at the bill of lading and then you have to go back and look at how the company booked it, there is some purpose of it, but I understand that looking at it for the first time, you might, like, the purpose might not be 100% sort of, you know, it wouldn't be something that you'd be like, oh, like, it won't be 100% intuitive, but there is a purpose for all this. So what is the accounting for the inventory? When we purchase the inventory, our inventory will increase, and depending on whether we purchase the inventory for cash or on account or on credit, we will decrease cash or increase accounts payable. Remember, I talk always about increases, decreases, just because in the back of my mind and in the back of your mind, you guys should be very familiar with, at this point, with when I say I increase the inventory, I mean I debit the inventory. And when I say I decrease the cash, means that I am crediting the cash. And when I say that I'm increasing the accounts payable, I am crediting the accounts payable. So debit inventory, credit either cash or accounts payable. When I sell the inventory, I debit the cost of goods sold and I credit the inventory because I'm increasing the cost of goods sold and I'm decreasing the inventory. Similarly to what we have done for sales, while in sales, we're not really focusing on the inventory piece. Now in inventory, we're not really focusing on the sale piece in terms of reporting transactions. And again, this kind of goes back. You may or may not recall this little diagram over here, this little figure over here, which I think it's so important, guys, because it really gives you a sense of what is a cost. In this case, so you have cost whose benefit is for the current period, like the transportation cost for Crest for the sale they made to CVS, and that's expense right away. That cost doesn't have a benefit past the sale to CVS. So I have to expense it right away. And the costs that benefit future periods, such as inventory, that are booked as an asset, capitalized as an asset, and also the transportation in. The transportation that CVS pays is a cost that was instrumental for me to get the merchandise to my premises so that I can then sell that inventory. Those costs have future benefits, so they are capitalized and expense when they're used. We have seen the example here. I purchased the inventory. That inventory, this amount here, the XX over here, it's comprehensive of merchandise, of the cost of the merchandise, transportation in, if applicable, discounts and allowances, if applicable. When I sell it, so I capitalize it and then I sell it when, and then I expense it, when I sell it. So we're gonna be talking about the retailer's cost flow. Like I said, we first start with retailers because they are the most intuitive to think about, and then AC 222 will help you navigate through manufacturers. But unless you understand the retailers, it's going to be very difficult for you to understand the manufacturing side of things. So here's the transaction. I buy, material. I put them in the balance sheet, And then so I capitalize them as inventory, oops. And when I sell them, they become cost of goods sold. That is the retailer cost flow. There's a material purchase. It gets booked into the inventory in the balance sheet. And then when I sell it, it goes into cost of goods sold. It's very simple. It's as simple as that. Things that we need to keep in mind, and this is true for retail cost flow and for everybody else, is that allocation and inventory, the allocation between the inventory, between assets and expenses. I mean, this equation should be something that it should be intuitive, but there's a new term that we are introducing. So we talked about sale price, we talked about cost of goods sold, we talked about cost of merchandise, which is cost, like a purchase of the items plus transportation, discounts and allowances if applicable. Now we're going to talk about cost of goods available for sale. And again, this is something that if you think about it, like, yeah, of course, this makes sense. But, you know, there's a term for it. So our beginning inventory plus the purchases of inventory during a period are what we call the cost of goods available for sale. What does that mean? It means that if I have purchased as CVS, if I had at the beginning of October, you know, 50 boxes of Crest on my shelf, and then today is October 2nd, is it? Yes, it is. And I get a new shipment from Crest of you know, 150 boxes, then the cost of goods available for sale, assuming no fluctuation in prices and assuming that the cost of the inventory for me, it's $1, is going to be $50 that I had as beginning inventory plus the 150 of the inventory that I purchased, $200. So the cost of goods available for sale can be split between the merchandise inventory, which is the cost that has of the inventory that hasn't been sold yet, and the one that has been sold. So today is October 2nd. CVS receives the shipment of extra 150 boxes of Crest. Now the cost of goods available for sale goes up to $200. Today, I go to CVS. I like Crest as you know, as a toothpaste, so I buy 5 of those. So now the merchandise inventory is 195. The cost of goods sold will be 5. Again, setting aside any price fluctuation. So the cost of goods available for sale of 200 has 2 components. The merchandise the Crest boxes that are still on the shelf of CVS that are now have a value of 195, and the one that I purchased that are $5. It still totals 200. So when you do transactions on inventory, you always have to make sure that your cost of goods available for sale equals the inventory that has not been sold plus the cost of goods sold. Try to do that math just to make sure that you did the math properly for the cost of goods sold. At any point of time, the cost of goods available for sale has to be the sum of the merchandise inventory you have in your assets plus the cost of goods sold. So, you know, like basically, if I'm looking at the retailer, I have a beginning inventory, I make purchases, I decrease the inventory by cost of goods sold, and that's my ending inventory. Easy, because you don't have anything associated with, you know, manufacturing and all that kind of stuff. So beginning inventory, purchases are debited, cost of goods sold is credited, ending inventory, you got to debit it because your inventory has a normal balance on the debit side. So if I have to think about transactions, in the balance sheet and in the income statement, I have a beginning inventory plus purchases of material. That equals cost of goods available for sale. less sell the product minus cost of goods sold. That cost of goods sold is transferred to the income statement. That's my ending inventory at that point. And that's like and I have the cost of goods sold that is moved from the inventory to the income statement, and it represents the cost of the inventory that I purchased. So with that model, cost of goods sold can be seen as beginning inventory plus purchases minus ending inventory. This is simple math. Therefore, the ending inventory is beginning inventory plus purchases minus cost of goods sold. Again, go through these formulas because they might be, you know, they are intuitive. I mean, you don't need a sort of, you don't need, you know, to be an accountant to figure this out, but you don't want to also, at exam time, for example, have to, you know, spend a lot of time about thinking of those. So you might as well like sort of master those formulas. As far as the accounting of the inventory, I mean, we went through it. This math seems pretty easy. So far, typically my students are very excited. They're like, okay, that's it. We are done with inventory. Not so fast. We need to think about what is the cost included in the inventory. Because obviously you cannot understand what I'm going to say next if you know, it would be very difficult to master if you have if all this doesn't come across as very easy, and if it doesn't come across very easy, then it's just a question of going back and review the material. But it is easy, but not as easy as you would think, because then what is the cost that are included in the inventory when purchased? First and foremost, think about it. Let's make another example. Bikes. I mean, like I became a savvy user of bikes thanks to the pandemic, but my inventory, say I have I'm a bike store, and my inventory is pretty much all bikes of last year. And there's a new release of all the bikes, of the models of the bikes of last year. My idea is that my assets, according to the accounting principles, I shouldn't be misleading and misrepresent my assets. But if I keep the bikes that I purchased for $200, then now, if I go back and purchase from, you know, bike manufacturers will cost me $100. If I keep them at $200 in my inventory, I'm misleading my public, because those bikes are not worth $200 anymore. They're worth $100 because there's a new release of bike that came out. So that's the first wrinkle there. I need to make sure that my assets are not overstated and my inventory is not overstated. But so there's a valuation rule. I have to think about, you know, like the lower of cost or market, which we're going to be talking about later in the chapter. But just so you understand, like the complexity of cost of goods sold. For merchandisers, the cost is the purchase cost, but once it's shipped to the customer, the cost moves from the balance sheet to the income statement, and we understand that. But what items or units we include? When the title, like the general rule is like, also you have to think about, when do the title passes to me? The FOB conditions may tell me when it passes to me. If the client, for example, if you know, if I'm Crest and I'm telling the CVS, don't you worry, I'll worry about the shipment and I'll send the stuff, whatchamacallit, the toothpaste at your premises, the merchandise is Crest's until it gets to CVS. So that's FOB destination. Instead, if it's FOB shipping point and Crest says, come get the toothpaste, then the merchandise and the title of that merchandise passes to CVS when they go pick it up. So CVS has to put it into the inventory as part of their inventory when they go pick it up. So see how like things that we do normally with nonchalance in our life have so many implications when we have to report them into the financial statement and inform the public. So the general rule that the title is, when title passes to a company, then that's where you book it as cost of inventory. You could have consignments, like where the title, like, consignment goods, where the title is still held by the seller until sold, or goods in transit where the title, like, is still held by, the buyer. It's legally owned by the buyer. So, you have to really look at the conditions, and you really need to look at, like, typically you find this information, the information in the bill of lading that tells you what are the conditions with which this merchandise is moving around. What cost to attach? Typically, somebody has a question. Just to clarify, title is merchandise. No, the title of the title is the title of ownership. Who has title of a merchandise? Yeah, that's a great question. So the general rule is landed cost. So basically, what costs to attach to the merchandise? All costs incurred that bring the assets to be usable or in resaleable condition. So invoice price, freight in, storage, even storage. I mean, like, not only the cost of transferring the merchandise in my premises that is instrumental for me to have the merchandise that I want to sell, but also storage. I need to put the merchandise somewhere. That cost of storage is capitalized because it's benefiting me in the future to sell that merchandise. It helps me to keep my resources. So all landed, quote unquote, costs are included in the cost of merchandise, of inventory. Then again, still you might think it's easy, but so we talked about and we solved for the what costs are included in the inventory when purchased. But then there's the bigger question. What if the cost of the inventory that I purchase changes over time? So today, let's make the phenomenal example of hand sanitizer. The new gold, liquid gold, that is like as you guys know, for a few months was nowhere to be found. And if CVS, if they had it, I mean, I don't want to pick on CVS, but actually they were pretty fair in the sale and in the price. But CVS must have so let's assume CVS used to buy hand sanitizer at probably 50 cents a bottle from Purell. When this whole madness came along, CVS probably had to buy that same bottle of hand sanitizer, if they got lucky and they got to buy it, for $1.50. But then CVS put the little bottle, I go around with a bottle of alcohol, a little bottle of, let's assume that this is Purell, a little bottle of that they purchased for 50 cents next to the bottle that they purchased at $1.50 on the same shelf. I'm a customer, I walk in, those bottles are identical to me. I pick a bottle of Purell. I go to the cashier. At that point, what is going to be the cost of goods sold? 50 cents or $1.50? We don't know. Unless you really want to have, think you have the time to put a little sticker next to each and every bottle, which nobody does. We don't know. So we need to come with an evaluation system that is sort of disjointed by the physical flow. Meaning I could very well sell physically the bottle that I just got in at a price that is different, and the cost of that bottle will be different from the one that I purchased it for. Because my accounting of the cost flow is different from the physical flow of the merchandise. So again, an appliance store has a beginning inventory of one television set. TV set one costed $250. You guys probably don't even know I mean, you guys are too young to probably remember that TVs looked like that before. I'm almost even too young to remember that. But that's a kind of cute little image. Then, so TV set 1, the cost was $250. TV set 2, the cost is $290. TV set 3, the cost is $300. It sells TV set, one TV set for $550. The TV sets, they all look the same. So the sales price is $550, but I bought these 3 TVs. One is $250, one at $290, one at $300. I don't know which one is which. And so what, like, I know how much I sold it for, but I don't know which one is which. So we're going to talk about, you know, we're going to think about like this example and talk about how do we measure this next class, because I do recognize it's 12:07, and this is a very exciting story that I think that I'm telling you guys. So we will continue this for next class, and we're going to introduce the concept of evaluation methods of inventory. But again, just to recap today, cost of merchandise, we talked about sale price, we talked about cost of goods sold, we talked about cost of goods available for sale, and that was a sort of like introductory part to tell us, yes, we can figure out all this, we know all this. Then now it comes the point of where inventory becomes a little bit more complicated, where I'm going to purchase at different costs. How do I evaluate my inventory and my cost of goods sold? All right, on that beautiful note, we will resume next week after the exam, reminding you the office hours. Again, like my office hours are today 3 to 4, and then next week 1 to 3. Those are exceptions to the rules. So because otherwise we're going to resume to the regular office hours. Come see me in office hours if you need to talk to me, if you want to talk to me. Otherwise, I wish you a great weekend, and I'll see you next week at the exam. Thank you, guys. Bye.
Thank you.
Thank you.
Yeah. Thank you.
Thank you.
Thank you. Bye, Martina.
Have a good weekend.
You too. Thank you so much.